Diving into our gains and losses, how are we going to net them all together? We've got gains and losses that generally happen on the disposition of property. Think about it, you don't really recognize any gains or losses when you purchase anything, it's when you sell things. Now, when a taxpayer disposes of property, the gain or loss recognized can be classified as either a capital gain or loss or an ordinary gain or loss. We'll see that capital gains and losses have preferential treatment, and as such, the tax rules are going to be strict in not letting you recognize it as capital and making you recognize it as ordinary in some cases. The classification depends on the nature of the asset being disposed of, how it was used, and the holding period of the asset. This classification is going to be crucial because it will, as we'll see, affect the tax treatment of the gain or loss. Talking more about capital gains or losses, these arise from the disposition of capital assets. One thing we'll see throughout this is what is a capital asset. Obviously, we've got some examples here, but we're going to have a lot more criteria as well. Makes sense, capital gains and losses tied to capital assets. Capital assets are generally defined as property held by a taxpayer for personal use, investment, or other non-business purposes. Some examples are going to include stocks, bonds, personal residences, and personal vehicles. The tax treatment of these gains or losses will depend on the holding period of the asset. Short-term and long-term capital gains and loss. We'll talk about why this exists on the next slide. But one thing to memorize if you don't have this in your knowledge bank already, if the asset was held 1 year or less, the gain or loss will be considered short-term. These short-term capital gains are going to be taxed at the taxpayer's regular income tax rate. For a long-term capital gain or loss, which is preferable, if the asset was held for more than 1 year, the gain or loss is considered long-term. Long-term capital gains have preferential tax rates, which are generally lower than regular income tax rates. That's super important because your regular income tax rate, that could go all the way up to 39%, but we'll see in the resources definitely have this memorized. But what are the long-term capital gains rates depending on your income bracket? Generally, they're going to cap out around 20-25%. Capital losses can be used to offset capital gains, and any excess capital losses can be used to offset a limited amount of ordinary income. This amount we'll see pop up throughout the entire course. Get familiar with it, love it. $3,000 per year for most taxpayers, and it is just going to be $3,000 that most taxpayers, that's beyond the scope of the exam. Unused capital losses can be carried forward to future years. So if you have a massive loss on stocks in this year, and let's say you never do stock trading again or any investing or anything like that, you can just continually use those losses to offset against your ordinary income, which is your wages, $3,000 every year maximum. Ordinary gain or loss, these result from the disposition of non-capital assets, which are typically used in a taxpayer's trade or business or held for sale to customers. Examples here are going to include inventory, accounts receivable, and depreciable business property, such as machinery, equipment, and buildings. Ordinary gains or losses are taxed at the taxpayer's regular income tax rate, and unlike capital losses, ordinary losses can be used to offset ordinary income without limitation. All of this classification, that's the name of the game here, it is classification. Super important in distinguishing between each. Now, what's the rationale? I like to give that this is going to help just remember, like, why is this going on? Obviously, we're going through a lot of tax law, and the IRS comes up with this, so why are they doing this? What's the rationale? Is this beneficial or not? And I'd say overall it makes sense. The rationale for the higher tax rate on short-term gains is to discourage short-term speculation in the stock market and to encourage long-term investment in businesses. And by taxing short-term gains at a higher rate, the IRS hopes to discourage investors from engaging in speculative trading that could destabilize the market. The IRS wants, just like the whole government here in this country, they want more investment in business. They don't want people buying and selling, and that creates volatility. So by holding your investments for more of a long term, that is an encouragement to make sure that you continue to do that, and that will help the American economy. And boy, do we love the American economy. You're going to see an example here, netting together long and short-term gains and losses. This is something you definitely need to know for the exam, and then questions could get a little more complicated, but we're starting off pretty slow. Nice here. An individual reports the following capital transactions in the current year. We've got a long-term and short-term capital gain and loss, 2,000 short-term capital gain, 14,000 short-term capital loss, 8,000 long-term capital gain, and $4,000 long-term capital loss. Now here, what is deducted in arriving at gross income? We've got the answer there, but how did we arrive there? Well, if capital losses exceed capital gains for an individual, the amount of the capital loss that can be claimed to lower income is limited to $3,000. So what we do first is net together these short terms. So we say that overall we have a short term loss of 12. We're netting those together. And then we net together the long term. And that's going to give us overall net long term gain of 4. So we've got a plus 4 and then a minus 12. And then we're going to net these together to give us a total loss of $8,000. Now, this $8,000 will be short term because we're using the long term to offset the excess of short term. So we've got 8,000 short term capital loss. And then we have our trick that we learned. We have that $3,000 amount. We are capped at $3,000 using this to reduce taxable income. Now, keep in mind what the question is asking. This is asking what can actually be deducted. So that is only $3,000. If it said what's your total short-term capital loss, or if it said what's your total long-term, that would be quite the different answer. What's your total short-term loss here would be $8,000. However, what would be your total long-term? Be 0 because it gets netted out. That is super important. Keep your attention to detail sharp. And then we're using 3,000 this year, but we've got 5,000 left of that 8,000. So that is going to be a carryover to the next year. All right, great example. Moving on. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.